Hey, you caught me preparing for this week's Week in Review video. We'll be talking about employment numbers and wages, Federal Reserve, China's impact on U.S. companies, the best January in 30 years, advisors acting poorly, the polar vortex, and Super Bowl. So stay tuned to hear all about these on your Week in Review video. Thanks for tuning in. I'm Justin Castelli, CEO of RLS Wealth Management. It's February 2nd, 2019, and this is your Week in Review for All About Your Benjamins and your weekly mixtape down below if you're reading or watching this on All About Your Benjamins. We're going to start this week's headlines with employment numbers and a little bit of wage information. So on Friday, we had a monster jobs report, 304,000 new jobs in the month of January versus a much lower expected number. I can't remember what it was, and I don't even know how they come up with these expectations, but the big takeaway is more jobs were created than expected. This gave us the 100th month in a row of jobs being added. We like round numbers, so that's pretty big milestone of 100 months in a row of more jobs being created in the U.S. economy. So that's a good sign. Wages ticked up about 3% year over year, so that's another good sign. We've talked about wages over the past year on the Week in Review videos. We know that the Fed is watching wages to see what that does to inflation and what they need to do with interest rates. We'll talk about them in a few minutes. A couple of things to note. Unemployment numbers ticked up to 4%. I think it went from 3.9% to 4%. Not a huge tick up. The reason why being cited, from what I could find, the government shutdown. So with the government shutdown, we had a handful of temporary unemployment people added to the numbers. Hopefully, we'll see that number tick back down because that will mean the government comes to an agreement. We don't have another shutdown later this month, and life is good for everybody in the government, at least from an employment standpoint. Other things that's to be determined on their own line. A couple other things to look at. Consumer confidence has ticked down some, and then also housing is slowing. So we have a report and an article that you'll see below that shows some good news on the jobs front, on the wage front. Unemployment is fine. But then we also have some conflicting numbers from consumer confidence and housing slowing. So what do we do with these numbers? Long-term investors, we have financial plans. These are good things to know to get an idea of what's going on. But I don't think we should be making major decisions, major changes off of these reports. So takeaway is jobs are good in January. We'll see next month how this month does. Next up on the list is the Federal Reserve, and they decided to pump the brakes. No raising of interest rates this month. I guess last month. And they are going to use the data to determine what they go forward. So softening of the language, no set raises coming up. And they cited a number of reasons for this, that there's enough risks out there that it warrants relying on data and not having a set plan. And they've changed their language over the last few meetings and last few conferences they've had. So what did they cite? They cited the U.S. maybe slowing down a little bit, Europe's issues, China slowing, Brexit, all of these things that Federal Chairman Powell said probably aren't going to be leaving us anytime soon, which warrants a more cautious and slower raising of the interest rates going forward. So these risks will be for a while. So we'll see what they say in the next report. But the market liked that they weren't going to be raising rates. So the market has had a good run this week. So before we get there, just another headline. We've talked about China and the tariffs and the economy slowing. There was a report and some numbers showing that the industrial sector of our economy is slowing and seeing weakness in China. And I say weakness because the article, if you read it, uses the word weak, more weak, weakness a number of times through there. You could probably do a drinking game with it if you wanted to. I bring this all up just because we've talked about the tariffs. We've talked about economy over in China slowing, and what does that do to the U.S. economy and the global economy? We'll have to wait and see how much more it slows, how much longer these trade conversations and tariffs go on, and does that bring things back later on. But we are global advisors. That's what I preach. That's what I believe in. So it's important to have an understanding of what's going on outside of the U.S. and not have a home country bias to our news. Along with our portfolio, we want to look at everything. So China continues to show some slowing numbers, and we're beginning to see that impact over here in the U.S. It's unclear if it's tariff related or if it's slowdown related over there, but they are intertwined and working together, and that's just another piece of information for you to have as you think about the big picture of your financial planning and portfolio. Next up, we had I'm going to put quotes, quote, best January in 30 years. What does that mean? It just means the market's had a good recovery. I bring this up not to get excited, not that this means anything for the remainder of the year, because as Federal Chairman Powell cited, there's a number of things out there that could derail things, and there's always those black swan events that we have no idea could even happen. I bring this up only because at the end of November through December, if we would have told you that you're going to have the best January in 30 years, would you have believed that? Probably not. Emotions are there, headlines are there, not a lot of optimism at the time, and here we are 31 days later, 32 now, 33, and the markets had a very good January. So I bring this up just to stress the fact that timing the markets is a tough thing to do. You got to time it right on the way out and the way back in. Many people, if they tried to time in December, probably missed this good recovery, and there's been plenty of studies that show you if you miss the best day, the best 10 days, what that does to your long-term performance. So I just think that January's return and January's performance of what happened should not be taken to mean anything for the rest of the year. It should just reiterate the fact that you should not be making active changes to your portfolio based off your emotions, based off the headlines. So that's the reason I bring this up, not to get too excited. It's nice to see the statements go up, but we're long-term investors, so 1 month is meaningless in the grand scheme of things. Next up, my friends in the industry, other financial advisors. A lot of good ones out there, a lot of bad ones still out there. I bring this article to you just for consumer awareness. So there are about 50 advisors that are currently negotiating with the SEC to limit their fees for overcharging clients, and not overcharging clients from the standpoint of a high fee, overcharging clients from the standpoint of using higher expensed funds. So a real quick example of this is you could have the same fund ABC, and they can have different what they're called share classes. Share class A, share class B, C, R, L, all these different share classes. Makes it extremely confusing. What those share classes do is they have different compensation structures, different fee structures. So as an advisor, I could recommend ABC share class A, which is going to charge you a commission up front. I get paid. Or I could charge you a commission share B or C, which maybe doesn't have anything up front, but has a higher internal expense. And the internal expense is something that you don't necessarily see. It's disclosed, but you're not reading the paperwork that shows all of this. You're going to pay a higher internal expense throughout the course of the year, which slows down your growth. And sometimes advisors get trails on that end. So nonetheless, end of the story is advisors are putting clients in share classes that were more expensive to the client, potentially paid the advisor more when they could have offered them the same exact fund ABC, but in a share class that was cheaper for the client, which is better over the long run. Maybe it paid the advisor less, but it was better for the client, which is a fiduciary, which more and more advisors are becoming, and I think all advisors should be, but as a fiduciary, that's what's supposed to be done. So I bring this to you not to put other advisors in bad light. I don't think there's any names out there, just for you to know and be aware of that there are advisors that aren't always using the best share classes. If you're not sure, ask your advisor. If they can't answer, that might be a red flag. Next up, leaving the finance world, the polar vortex this week, can't talk, ran through the Midwest. We had it here in Fishers. The boys were off of school for 2 days because we had negative temps and beyond negative when you add in the wind chill. And then we got Friday, we had a lot of snow. So the polar vortex this week raised havoc for everybody. Kids staying home from school. We have e-learning, so we have to run them through a bunch of education things on their iPads and different homework assignments, but that allows them to not make up school later on. I have mixed reviews on that, so we can share that offline some other time. And finally, Super Bowl Sunday is here. I have to give a shout out to the Chiefs. I forgot to do this a while back. One of my friends on Twitter, we made a bet. I was supposed to get a Chiefs shirt when they beat the Colts, and he was very kind and said, take that money, put in your kid's 529, just give us a shout out. So it's a few weeks late, the Chiefs are out, but I've got to do what I've got to do on the bet and give a shout out to the Chiefs here from Indianapolis. You guys were the better team a few weeks ago when you beat us. But when we go into the Super Bowl, we got Rams versus Patriots. As a Colts fan, as a lifelong Indianapolis citizen, it is blasphemy for me to say this, and I know a lot of people out there don't like them, but I'm going to be rooting for whatever time I watch the game for the Patriots. Now, the reason I root for them is because so many people root against them because of their greatness. And I have a hard time not respecting greatness, not respecting consistency. And when people hate on that, that makes me want to root for that. So I'll be rooting for the Patriots. I probably won't watch much of the game, really don't care. But I'm rooting for Tom Brady, the Patriots, even as a Colts fan. That's just how I roll on this one. Won't be mad at the Rams win either. It'd be kind of cool. But anyways, I'm rooting for the Patriots. I digress. So that's it. That's everything for this week's Week in Review video. Be sure to hit down below if you're on All About Your Benjamins and check out this week's weekly mixtape. A lot of great blog posts came out this week, so make sure you read those. Broaden your horizons, learn more about this industry and things that people are talking about. If you're watching this on YouTube, head on over to allaboutyourbenjamins.com to check those out. The link will be down below in the extra information area. And if you're listening to this on Sunday morning on your Amazon device, head on over to allaboutyourbenjamins.com, find the mixtape, and read all these articles below. So thanks for watching. Be sure to subscribe to the blog post, to the blog, to the YouTube channel, to the Amazon skill. If you're not subscribed, please do that. Give us some like, give us some comments. We'd love to have some feedback, and also share these with your friends and family members if you think it's good for them. So thanks for watching, and we'll see you in the next episode.